Hey, everyone. It's Jennifer Schurter with Real Broker back again for episode 3 of Real Estate Recess. Have some great things in store for you today, so I hope you'll stick with us. We're going to talk about a Northwest favorite burger chain is making some expansions, and they're moving into a local city here in Clackamas County. And I want to know what you think. So if you think you know where it's going, leave me a comment. Would love to know where you think this place is going. All I can say is Target and Costco runs in this particular area are going to be a lot more fun when you can get yourself a hazelnut milkshake, right? Another thing we're going to talk about today is we're going to talk about the Canby planning, the planning of what's going on with our expansion here in the area. And they did something called a sticker test in a recent meeting where they identified some land around town for future development. And it really brought some questions to my mind as a farm kid. What about developing farmland into suburban neighborhoods? Is it a good idea? And is it something we need? So, we're going to talk about that. And finally, really excited to introduce to you one of my friends, Tina Colson-Jones. She is with Equity Advantage, and she is going to break down the nuts and bolts of the 1031 exchange. So, anyone out there who's watching and wants to know a little bit more about what that's like, she's going to break it down. And here she is, Tina Colson-Jones. Welcome to the
Hello.
stage, my dear.
Thanks, Jennifer. Love to be here. Super excited.
So tell us a little bit about
Mhm.
yourself. I just, I've known you for a long time. We go back to when we were, I think it was the Lake Oswego Chamber of Commerce back
Yes.
like 14 years ago or something crazy. So it's been a long time,
Fantastic.
and
Yes.
you've had quite a journey. I like to refer to you as the consummate networker.
This is true. So I think networking, it's in my DNA. I love it. I love people. I love just getting out into the public and discovering new businesses, discovering new, areas. But so my whole background, I am a Northwest girl, born and raised, Oregon City area, and now living in Canby. Absolutely love that community. And as far as my background in real estate, I have been doing this. I'm going to date myself like 30 plus years, and just kind of started out in the mortgage industry, worked my way up through the ranks to loan officer, brief time there, and discovered I really loved the business development side. So I worked for a title company in that business development account marketing side, and then also worked for a nonprofit and worked there for 12 years, but helping investors who were selling their real estate to do charitable remainder trusts. So it was kind of
Right.
another option for them. And then I came over to Equity Advantage here 5 years ago and absolutely love this. It's such a niche market, but do you realize that 64% of real estate sold could probably do a 1031 exchange with it? So that's what I love.
Wow.
I love educating people and just kind of giving the full spectrum of what's out there and the opportunities available. And 1031 is my gig. So, yeah,
Awesome.
super fun.
Love it. Love your passion. Love that. I think that that comes through in everything that you do for the folks you work with. So, can't wait to hear more from you about the nuts and bolts, like I said, on that 1031 exchange and having you break that down for everybody. Because I think anybody out there who's like a budding real estate investor or maybe has a property that has some equity that
Yeah,
would well serve them by moving some of that into a 1031 exchange could be a great option. So,
absolutely.
looking forward to that. So, shall we dig into our topics? What do you think? Let's start with it's lunchtime and we're going to talk about
You
this
mentioned
Northwest.
Burgerville.
I know Burgerville is the Northwest favorite. So, and I saw this article, and Canby has a Burgerville, and we love Burgerville. It's our, you think about regionally, other parts of the country have their burger chain.
Yeah.
California has In and Out, even though In and Out's moved up here too. It's synonymous, I think, with California to have the In and Out. And then you go to Texas and you have Whataburger, but the
Yes.
Texans I know out there say Waterburger, so you got that. So you got that, and then here in Oregon and, Southwest Washington, we have Burgerville, and so it's been a while. So according to this article on the, Portland Business Journal that I
Mhm.
found, it's, they're expanding. They're putting some more locations out there, and one of those locations that's amazing, can't wait for that, is going to be Wilsonville. It's
Wilsonville.
going to be moving in to that area there by, Costco and Target. So there's a Burger King that used to be there
Mhm.
by the Panda Express. That's gonna be a Burgerville.
Yeah.
And, so I don't know. When I think of that, I'm thinking Target and Costco runs, it's gonna be instead of a coffee, sometimes it's gonna be a milkshake in my hand.
You have to definitely mix that in, and I love that they always have local sources for all of the food that they make, and their burgers are amazing. I mean, for me, instead of the shake, I think I have to go with maybe some truffle fries or definitely a bacon cheeseburger. I know I shouldn't, but I just can't help myself.
It's alright. Hey, treat yourself. Treat yourself, Tina. It's
It's
okay. You
it's
can do
all
it.
good.
Yeah, it's all good. You can absolutely have it. Yeah, I think it's, and then I don't know that I've seen another fast food chain like Burgerville that's actually gone
Mhm.
through and is so focused on the local side of things.
Yeah.
It's quite interesting that, just the lengths that they go to have those local partnerships. I think that's amazing,
Yeah.
and it supports our local industries here, which I think is wonderful. So, anyway, that's Burgerville. Burgerville's coming to Wilsonville, everybody. So if you didn't know, now
Woohoo!
you do, and, glad to see a local company is making some expansion to their other areas. I know Bend is another city that they're moving into as well. So be on the lookout. There might be a Burgerville coming around the corner to you. So glad to see it. Yeah. What's so the bacon cheeseburger is your favorite? Do you
I
have
think bacon cheeseburger. I don't know, it depends if it's a breakfast or lunch, I'm a breakfast girl too, so
yeah.
it's gotta
Yeah.
be a bacon burrito then, obviously. So,
Right.
I'm not too picky.
Awesome. Yeah. That might be where I'm going for lunch today. I don't know about you.
Right?
I'll have to talk about it. Awesome. So our second topic today was, recently there was a meeting here in Canby called it's like a community summit called Cultivating Canby. And this is what they're doing there, from what I could tell in this article in the Canby Herald. They talked about the future of Canby and what that's going to look like as we continue to plan ahead for development. And one thing we know is for certain is they're not creating more land. The land that we have is what we have to work with and to accommodate the needs of the city as it grows. And so they're anticipating, according to this article, that there could be, by 2043, about 25,000 people total living in town. So adding 6,000 residents to the area, which doesn't sound like a lot, but when you're a small town, it's pretty significant growth. So what they're doing is they're looking at areas outside of town that could be identified as places to expand that urban growth boundary. So and now, Tina, you're familiar with the area, and you
Yes.
know that
Mhm.
Canby has a lot of farmland around town, and
Yes.
that's what adds to our charm, and it's really part of the history of our area, the agricultural community here.
Yeah.
So, I don't know, what do you think? And when you think about developing farmland and, planning ahead for the future, what comes to mind for you when this topic comes up?
It's such a mixed bag because the farmland is the charm, which is what draws a lot of people to the area. I think that was me included too, because you've got the small community city feel, but yet you've got, the beauty of the open space as well. It's just a really good mix. I think that, especially now in our housing crisis, if you will, because we just don't have a lot of inventory. I think that the build needs to happen, and it's great for the builders out there too that can sell their products. Um, and as for me, I think if we have those building spaces and just a little bit of land to enjoy with it, it's a perfect blend.
Right. And I completely agree with you on that, that as a real estate agent and looking at the inventory levels that we have in the area, we're still very much in a seller's market. And you know that law of economics that anytime there's a low supply of anything and a greater demand for what little supply there is, that always means prices go up. And so continuing to see that happen, it's an affordability concern when you have no inventory for people that want to buy. And multifamily housing only meets a need for some of our residents. There are people that are going to want to buy properties as an investment for their future and their family because, gosh, people who own property have a much higher net worth than people who don't. And so, and it's one of those things that's attainable for a lot of people to do. So lots of things are in my head. I
Mhm.
always come back to, growing up on a farm, and I think it's a shame because our area, the Willamette Valley, has so much fertile, incredible soil for
Yes,
growing food. And
yes.
again, it goes back to there's only so much land. We only have
Mhm,
so much land to go around, and it has to be used for what we need. We can't
mhm.
feed a population when there's no land that's you can work with. So
Right.
it's a hard thing because a lot of these farmers too, there's only so much they can do, and as generations age out of farming and younger generations don't want to take over, what do you do with the property and different
Correct.
values and different visions? And so it's really interesting to see. I would like to say there's a right and a wrong answer, but I don't know that there is. I just see pros and cons and challenges and benefits of both sides of that argument.
Yes,
But
I totally agree with you. And I would say, for anybody out there that is, and I was included because recently went through a house transition, thanks, Jen. You're
yeah,
awesome.
you bet.
Um, but I look at all of it and I think, I'm drawn to that land component. I would love an acre, 5 acres, right? It's hard to obtain, like you're talking about. But I think for folks who are just trying to get in to a property, even if your hopes and dreams are to have more of that land and that little bit of space around you, I still think that buying a property to get into a house, if you don't already have a house, is the key piece because, like you said, you're going to build equity. It's going to happen. Our prices are going up. And even though
Mhm.
our interest rates may be a bit of a challenge right now, I don't think we'll ever see that 3% rate again. But if you get in, you can always refinance when they come back down, even half to 1% in an interest rate is going to make a big difference. And
Oh,
there's so many
it's
loan
huge.
programs out there. So, for me and looking at this, of course, we work on the investment side of things with the 1031, but as a homeowner and just looking in general, get a house no matter how large or small it may be for you. It's that first stepping stone that really matters. And then you
Yes,
can always grow from there.
absolutely.
Yeah.
Yes, great points, super valid points,
Mhm.
100%.
Yeah.
Yeah, so it'll be interesting, and also in Donald, I know this isn't in Canby, but in Donald, there's a community going in. I don't know if you've heard of this one, but the early discussion of it was that it was called an agrihood, so it's kinda
Oh,
an interesting concept, but it's the idea of, I guess, marrying the agricultural component and not completely wiping that out of that space, but having
okay.
the development move in with it. So you kinda have it's like you have community gardens and you've got the neighboring farms that are still there, but it's kind of trying to integrate development and also keep the agricultural heritage of an area. And if it can be done, and that's a way that we can maintain that, I guess I would call it, stay away from that urban rural divide where we're just going to come in and urbanize and just completely
Right.
turn everything into a concrete jungle and not cut off our nose to spite our face, right? Where we just get rid of the
Yeah.
farmland that we need for our community to grow food and provide those products we need. I think that that could be a great solution if that's something that folks are willing to take a look at. So, uh,
Absolutely.
very, very interesting concept, and that's that neighborhood out there in Donald that's being built right now. And that's, Donald's a little tiny town, and it's growing too. It's happening
But it
everywhere.
is not that far from Canby.
It is not that far from Candy.
It is
That's
not
right.
that far.
Yes.
Yeah, and I love that idea. I think that concept, of having both worlds, and still hopefully on that affordable level for folks that can still experience the beauty of that farmland and have their place too. So that's
Right.
great. I'm
Yeah.
excited to see that.
Yeah. It's great. So it'll be cool to see that when it's done. There's several phases with that particular development. So yeah, it'll be really cool to see that.
Yeah.
So, okay, well then that's what's going on here in Canby. They're identifying all these particular parcels of land or area around town, and the idea being that at some point, some of those areas just on the outskirts of town could be integrated into that urban growth boundary, meaning that it could be developed. And that's not just residences, but that's also commercial and employment sector. So trying to also say that if we're adding population, we need to make sure we have reasonable amounts of employment for the folks that are moving here. So they're planning for that too and thinking what are the best places for that. So that's what this is about. This community summit they had did the sticker test and they identified possible areas where that the land could be in play for that at some point. So that's that update. I'm sure Canby's not the only city in the area that is undergoing some of that. There's only so much sardine can we can put into Portland with that urban
Right.
growth boundary and with Metro. So
True.
very interesting to see what's going to happen there. So that leads us to our next topic, and that's you, Tina. This is all about you and your slides are gone here. That leaves you and your information. So why don't you give us a quick intro and let's talk about the 1031 exchange and why somebody who's interested in real estate or who
Mhm.
is curious about investing and why
Absolutely.
this should matter to them and why they should consider this as an option.
Yeah, and so this is the consolidated version. If you really want the hour long the hour long PowerPoint, just get a hold of me and I'm happy to answer questions too. But if you want to advance to the next slide, and I'll just go over, what the 1031 exchange is. So with the IRC 1031, it's been around for over 100 years. So in 1921 is where it all started. And the exchange is basically an IRS authorized process that allows a person to take their like kind business or investment property, sell it, defer the capital gain into another like kind property. So they don't have that immediate tax liability to the property owner. And we call the property owner the exchanger in this case. So next one is, what is our role in this 1031 exchange? And that's on the next slide,
Okay.
if we can get there. So a qualified intermediary is what Equity Advantage is. This is what we do. So we are basically your legal money holder during the transaction. If you are selling a piece of property and you want to defer the tax, if you were to go in and close on that property without having your exchange set up first and exchange documents in place, you're automatically going to be taxed when you receive that check or the proceeds from the sale. So what do? We're going to consult with you. We're going to structure that exchange, make sure it's exactly what is in your vision of where you want to go to defer those taxes. And then also we're going to prepare our legal agreements, and we oversee that 1031 exchange process, and we help you along the way with that. We work really closely with escrow and or your closing attorneys, if that's who you have in place, to make sure that compliance is taken care of for, again, that tax deferral. So the biggest thing that, I could say with the 1031 exchange is, one, if you're even contemplating doing a tax deferred exchange, make sure that you are pre-planning before you intend to sell or purchase a property in an exchange. You always want to have your exchange documents in place. We have a lot of folks that call and say, oh, hey, I closed on my property 2 weeks ago, but I understand that I've got this timeline that if I buy another property, I'm tax deferred.
Mhm.
Not the case. That's a big fail. And unfortunately, you're going to pay the tax. So
Yes.
Next slide.
Yeah, and that's anybody who's out there. The key point, and I will stress this and agree, is that pre-planning for
Mhm.
anything is so important. So if this is something you're thinking about doing and you have not listed a property that you're wanting to sell, have these conversations and, talk to
Mhm.
your agent and also be very thorough in planning out the details for what that money's going to do because you don't wanna get that tax bill. That's,
That is
no good.
That is correct, and again, like Jen is saying, make sure, tell your real estate agent you're wanting to do a 1031 exchange because there is language that goes in that sales contract as well, whether you're on the purchase side or the sales side of an exchange. So you wanna make sure that boilerplate is in there. The other thing is make sure your escrow officer knows. So all parties are going to work together to make this a smooth transaction for you.
The dream team. I call it the dream team.
The dream team, and don't forget your
Dream
CPA. They are very
Yes.
important in this too. So let's
Yes.
go to the next.
Yes.
Yeah, next slide. Everybody has a role in this, and it truly is the dream team when it comes to the exchange. So the next thing is who benefits from this? Like I referenced before, 64% of real estate sold could potentially go into a 1031 exchange for tax deferral. And again, it's a deferred tax. The tax never goes away. You're not going to get rid of it, but you're kind of kicking it down the road to give you more capital to work with upon that execution of your sale. Now you've got more money to roll into the new property as
Mhm.
well. So, as far as who can benefit from this, anyone who has held real property, that means it's going to be taxed as real property as an investment for a period of time. So what does that mean? It means that if you are an owner of vacant land and you've held that land for a year or longer and you're looking to sell it to go buy something else, maybe you want to purchase a property as a rental property, single family rental, a condo, something like that you're renting out, you can swap that land for a single family, multifamily, commercial property.
Mhm.
You can go back into land. There's a lot of different options. So vacant land qualifies, owner of a second home. So there are some different rules around the second home, and you want to limit your use of that second home for, 14 days or 10% of the time it's rented in fair market value for the first 2 years prior to selling or disposition. If you purchase a second home, you can still use it, but again, limit your use. And you've got that 2-year rule when you purchase a second home as well. And we work all over the United States, so you can go anywhere, including Mariana Islands, Virgin Islands, and Guam. So those are some of our
Wow.
other areas that are included in the U.S.
Great.
territories.
Awesome. So
Um,
not just states, territories are included.
it's
That's amazing.
Yes, absolutely. Puerto Rico, no, but we can
Okay.
get you in some other cool places. So keep
Awesome.
that in mind. And then also a person with a business component to their property. So here we've got our farmland. We've got, a lot of folks that have, agriculture. Maybe it's a vineyard, and maybe their primary residence, their home is sitting on that land as well. We can always do a partial exchange and allocate funds. So if you've got an additional dwelling unit, maybe a home office with COVID, a lot of people went into the home office scenario, a
Mhm.
shop, again, used for business purposes, all of that can qualify for 1031 exchange. And again, we allocate a portion of funds. So if you sell a property, your primary residence, as long as you've lived in that primary residence for 2 out of the preceding 5 years, you get an exclusion of gain, 250 for an individual or up to 500,000 for a married couple filing jointly. You can take that portion of your property, let's say it's 25% of your overall property and 75% is your land and your working farm, right? Or vineyard.
Mhm.
That 75% we can carry through for a 1031 exchange. So it's not an all or nothing. You can do portions of, you can sell the whole property. The only thing that does not work in this instance for 1031 is going to be flipping homes. if a developer wants to come in and build or builds a home and then they're looking to sell that home right after it's built, that doesn't work. You would want to rent it out for at least a year, and then you could sell that home. So there's a lot of different rules. And again, my contact information will be here. Give me a call if you ever just want to talk it through and figure out your specific scenario.
Perfect.
So that works.
Great. All
And
right.
then our next slide, please. Thank you. So what is gain? This is a misconception a lot of the time when we're talking to our clients is they may think that their gain is solely, hey, I paid 200,000 for my property originally and I'm selling it for 500,000 and now I've got 300,000 in gain. Unfortunately, that would be your profit, but gain is calculated a whole different way. So this slide kind of shows you how to get to that gain level. First, you need to calculate your basis, and that's where it gets a little quirky. Again, accountants are amazing. Talk to your accountant to figure out what your
Mhm.
actual gain is. So with that basis, you're just going to take your purchase price, what you originally paid. If you've made any improvements to that property, capital improvements that have not been expensed yet on tax returns in the past, you can add those improvements back in. And then the depreciation is what gets people. So anytime you've got a rental property and or business, you should be taking depreciation on the actual structure itself. So you need to subtract out any depreciation that has been taken over the
Mhm.
years. That's going to give you an adjusted basis. And then from there, you can look at now, what are you going to sell that property for? What's the gross sales price? Less any real estate commissions, title escrow fees, R fee. So
Mhm.
that will give you an adjusted sales price. So take that adjusted sales price, subtract your adjusted basis. That's your true gain. That's where it gets
Mhm.
really confusing. And if you end up in, we had the crash of 2008, 2010, in that era, we ended up with something that was even called phantom gain because
Oh,
now
wow.
the debt, if your debt on the property is greater than the value, now we use the debt component as the value. So some people, even though they were losing their properties, maybe in a foreclosure, they had what's called phantom gain. So
Wow.
it's not as easy as it seems when it comes to this computation and what you're dealing with. But again, CPA can be your best friend. Have a
Mhm.
good
Mhm.
CPA. So yeah,
Yes, critical. I think
it is.
anybody who again, it's above my license to advise on those things, but
Yeah.
I think anytime you're out there and you're considering your options and what you wanna do with your investments, if you don't have a CPA and you're new to the real estate investment world, I think
Mhm.
before you hire a real estate agent or a
Mhm.
mortgage broker, get with a CPA and tell them what your goals are and tell them what your intentions are. And they are going to help you straighten out and iron out your whole financial picture and what you should do and what you should look at. And then that's when you'll have a good base knowledge of your individual situation. And that's going to set you up for a better conversation with a mortgage broker, with a real estate agent, or with somebody like Tina, who's going to help you plan that 1031 exchange process.
Yeah, and, like Jen, so I cannot give tax or legal advice. A qualified intermediary cannot do that, but again, CPA can. So
Mhm.
I agree, it is crucial that you talk to somebody that has that knowledge.
Right. Right.
And
Okay.
next, so 1031 exchange, what tax is deferred? It is more than the gain. That's the good news. So when we're looking at your taxable amount in an exchange, you've got the federal gain, which is going to be either 15 or 20%. Some people have zero, but you have to remember that when gain is carried over onto your income at the end of the year, it's going to boost your brackets of your income brackets. So we see mostly that 15 or 20% on the federal side. In Oregon, we've got a 9.9% state tax. if you're coming out of Washington, again, we work nationwide, so we see a lot of different tax structures and percentages out there. But Washington, very lucky because they are still not paying tax upon the sale of
Mm.
real estate. Your depreciation is always at a 25% level. And then if you fall into a certain income bracket, you may also see a 3.8% healthcare tax that's tacked on. Um, and then there is also an alternative minimum tax that could be the 26 or 28%. So those are for the really high income earners. But just know it's not just the gain of 15 or 20% you're looking at. It is a combination of all of these taxable pieces. And I would say 30 to 45% is generally what we see. Our high income tax earners or income earners are looking more at 50%. So it could be a
Mm.
huge tax hit when it comes to that,
Wow.
which is why the 1031 is favored for any investment property. So you can
Wow.
carry it forward.
That's a lot.
Yeah.
50%. Goodness.
Right. Yeah.
All
So
right.
it does make a difference, and the exchange can help a lot of folks get to that next level.
Okay.
So let's go to the next one.
Here we are.
Are four cornerstones of an exchange. So, first, something must be given away and something received. It's an exchange. So, the property given away must be held for investment. We like to see at least a year or longer on our side to do that 1031 exchange. And the same thing with the property being received, it must be held for investment for at least a year or longer. The relinquished and received property must be of like kind. So, like kind simply means it is real property. And again, I'll break that down. Real property means it's taxed as real property. An example of something that would not be taxed as real property is maybe you have land with a mobile home on it. And that mobile home has not been taxable as real property. It's considered personal property because it is still mobile, it's movable. Those are the things that you look for in a 1031 exchange, saying, okay, what do I qualify for? But even if a
Mhm.
person has a land, piece of land, and they want to sell it and it's got that mobile home on it that is considered a personal property piece, we can still do the exchange for the land component and the value of that. So keep that in mind. But like kind simply means more the nature of the investment, not the investment itself. So you could sell land, you could go into a single family commercial property, into a Delaware statutory trust, which is a passive investment. A lot of our retired folks like to go into those because they're done managing property. There's just a lot of options out there. So that's like
Yeah.
kind. The napkin test must be satisfied. Napkin test, this literally came from an attorney who was sitting at a counter and then grabbed a napkin and started writing down a calculation. So that was Marvin Starr back in the day. And
Mhm.
it's simply a matter of determining if the exchanger is trading across or up in value, equity, and mortgage. So, what we like to see is if you're selling a $500,000 property, we want you purchasing another $500,000 property. If you
Mhm.
have, 300,000 in equity, use 100% of that money toward your new purchase. You simply get a loan or bring in cash to offset the difference when you go to purchase that new property on the other side.
Mhm.
So, what triggers tax in an exchange is one, you go down in value from what you sold to what you purchased. You'd have tax on the difference. If you pull cash out of closing, you would have tax on that cash. There's a couple other things that could trigger tax in an exchange, but again, we can go into the nitty gritty on another day. And then
Yeah.
the last one, continuity of vesting. So when we talk about vesting, we're talking about how do you hold title on the property that you're selling? So if, classic example, Oregon is a non-community property state. Where some of our folks may get hung up in an exchange is if you have, easiest way to say taxpayer selling must be the taxpayer purchasing on the other side.
Mhm.
If you have a husband and wife and maybe they got married later in life and one of them kept their former residence as a rental property and now they're looking to sell that, but only one spouse is on title. In Oregon, a non-community property state, we're going to ask the owner who's on title of that house, do you want to add your spouse and purchase together as husband and wife on the other side? Or do you want to, just purchase this new property as a single individual? And so if they want to purchase together with their spouse, then we are going to quit claim. We would advise them, again, talk to
Mhm.
your CPA first, but you could technically quit claim that spouse onto title before you sell the property. Now both of you can move across in the
Mhm.
exchange and purchase together on the other side. So
Mhm.
that's one way. We also deal a lot with maybe LLC or partnerships. If you've got two people in an LLC and they want to split their separate ways, you would want to deed out of that LLC as tenancy in common before you do the exchange. And again, the sooner you can do that and hold that tenancy in common for at least a year before you sell, that's your cleanest way to do it. That allows each partner to go their separate ways, purchase
Mhm.
what they want on an individual basis on the other side. The only other way to do it is sell in the name of the LLC, and that entity is the taxpayer, and then purchase the next property in
Mhm.
that same LLC. So, any questions on that, Jen? I know it gets really quirky. We could go
It's
down into the
yeah.
weeds.
I think the important thing is just like anything, every individual situation is so different, and I think we can give so many basics about these situations, but no two clients that I've ever dealt with in the real estate world have ever had the same needs. Everybody's somewhat different because
Yeah,
their financial picture, their goals, everything that makes up what they're trying to do are different, and so I
right.
think the important thing is that, just know that going into this,
Mhm.
Mr. and Mrs. client that are out there, know that going into this that you're going to have, your own unique things to plan for. So and that's where these professionals come in to help you
Yeah.
with every little specific quirk and detail of your situation. But I do have a question that
Yes.
I'm sure people out there ask all the time. So, let's say they identify a property
Yeah.
and they have $300,000 that they're bringing to the 1031 exchange, and they need some cash to improve the property.
Mhm.
Uh,
Mhm.
can they use their 1031 exchange funds towards improvement of the property, or would those funds have to come from outside the 1031 exchange?
Great question. And yes, we can use exchange funds to improve a property, and that is called an improvement exchange. And so we can do multiple types of exchanges. And I don't know, there may be a slide in here that talks about the type of exchanges we do. Um, and just a brief overview. So, a delayed exchange is where you're going to sell first and purchase on the other side. It's very simple, straightforward. If
Mhm,
you're doing a reverse exchange, you are going to find the property that you can't live without, and maybe you want to purchase it before your property is ready to sell.
mhm,
We
mhm.
can do a reverse exchange. And then the next one, as you're talking about, Jen, is the improvement exchange. So you can go out, you can purchase a property, and if you've got excess funds, of course, it's got to make sense in the exchange window because you still have timelines, which we'll cover, but you can use your proceeds to make those capital improvements to that property.
Okay, very good. So it really just depends on the type of exchange you're doing,
Mhm.
in
Absolutely.
theory. Okay, very cool. Great answer.
So we're ready
Okay.
to roll to the next slide. Oh, and here we
Change
go.
type. Wow, look at that. How perfect. What a
This is
great
fantastic.
transition.
like magic. So
Magic.
yeah, again, delayed exchange, sell first, buy later, reverse. You're going to buy first and then sell later. We are not a bank. We just need to let you know that. So you would need to have your financing set up, or if you're going to purchase cash, that's a great way to go too. But again, all of the details later when we have more time to do this. Improvement exchange, improve property you purchase. And then also we can do a blended exchange. Any one of these could come into play. And where we see the blended exchange a lot is maybe we've got a client who is selling two properties and they want to purchase one larger property in the exchange. Their first property is ready to sell. It's on the market, and they may even have an offer at this point. Where their second property, maybe they still have a renter and there's another 30, 60 days before that renter is out to where they could sell that property. They find their new property. And when we are looking at exchanges, we're looking at the closing date of when each close falls into place. So maybe you close on your first sale property, and now you found the perfect property and you need to close on that replacement before your next second property is ready to sell and close on it.
Mhm.
So in that case, we do a blended exchange. We start out as a delayed, and then when we purchase the replacement property, we're going to shift it to a reverse exchange, and then we'll sell that next property that comes later, and we'll dump all the money into this new replacement property. So that is an
Awesome.
example of a blended exchange.
Cool.
Yeah.
That's great.
And I will mention, we can also, something else that this gets more in the weeds, but we can do also what's called a leasehold improvement exchange. So if you guys have anything that is maybe we see quirky things like cell towers that have a lease on that cell
Mhm.
tower that is at least 30 years, or maybe it is leased land that is at least a 30-year lease remaining. We can do
Mhm.
exchanges on that type of property as well. So just
Great.
FYI. And then again, what I was talking about, exchange timelines. So regardless of whatever type of exchange that we are doing, we are held to strict timelines through the IRS. And we have 180 days total for your exchange. And the timeline begins upon the first property closing date. So once that property closes, the first 45 days of that timeline is going to be your identification period. Identifying means that you're out shopping, and when you identify a property in that 45-day window, we're going to send you a form to fill out, and you're going to put in that actual property address of what you're looking to purchase.
Mhm.
You can identify up to 3 properties of any value. If you go over 3 properties, now you get into some other identification rules like the 200% rule, which means if you sold a $300,000 property and you chose to identify 4 or more properties to purchase in the exchange, then you don't want to exceed 200% of that
Mhm.
$300,000 value on the sale. So you would not want the total value of everything identified to exceed 600,000, or you're going to be over into the next category, which is the 95% rule. And we try to stay away from that because it means that you have to identify 95%, or close on 95% of everything identified. Again, we're getting into the weeds. I'll try to,
Mhm.
back off there, but 45-day is your identification period. You need to be specific about the property that you're looking to purchase, and then 180 days total to close on that property that you identified. We're held to whatever you write down as those properties of identification.
Sure.
So,
Cool.
and
Okay.
then I think that was the end.
Ta-da!
Oh my goodness.
Amazing.
And there is so much more
Amazing.
I could tell you. I could go on for days, but you probably don't want to do that right now.
Yeah. I mean, we could. There's nothing stopping us other than my computer battery,
Right? There's
or
always
having
another
to pick
day.
up my children or something, Other than that, yeah,
Mm,
I know this is such a topic. There's so much depth, just like anything, that
yeah.
there's so many details. And again, with every individual situation, it's going to be so different. And so you could really benefit if you're out there looking into options and you own property and are considering
Mm,
selling it to buy something else. You could really honestly benefit from a conversation with
yeah.
Tina and Equity Advantage to get some of these things lined out. And as you saw with those timelines, we will emphasize that again. Those timelines are critical. 45 days, 180 days seems like a lot of time, but I tell you, a normal close on a property today is about 30 days in our area,
Mhm.
and that goes by so darn fast. It is just
Yes.
so fast. So again, the pre-planning, it's the, what is that? The 5 Ps or whatever, prior planning prevents poor performance. I think that really applies in this situation,
It
that
does.
do the planning so that when those timelines
Mhm.
come, you're ready to hit the ground running and you're not going to be caught off guard
Yeah.
and have something happen where then you get taxed on this money that you have.
Yeah.
Um
And
yeah.
Jennifer too, from your perspective as a realtor and out shopping for property for people, there's ways that you could work with your client too, I'm sure, of
Mhm.
helping to write an offer that can maybe offer an extended closing date. Like if you find that property and instead of doing a reverse exchange, it allows just a little more time for
Mhm.
the client to close on their relinquished property, the one that they're going to sell.
Right.
But I'm sure that there are methods around that that you could work, with your folks and
Exactly.
help them get in that best position possible moving forward.
Right, it's all about that
Yep.
consultation
Yep.
and sharing information and making a plan and being strategic. It's all about the strategy, just like anything. You know,
Yep.
we have to plan, and the P's count on my side too as an agent. So it's important to know all the details and say, how are we going to execute this? And having good communication with partners like Tina
Mhm.
and Equity Advantage, or the mortgage broker that could be involved if you're not doing a straight cash purchase, and the CPA. So everybody knows and is moving in the same direction for you as a client to achieve that goal. Um,
Yes.
we can all be in concert with one another, as you might say. So that's amazing. Tina, these slides, would you be opposed to having me share these with folks? I can supply a link, or I can direct them wherever if anybody needs anything, or maybe they could call
Absolutely.
you. What do you think? Obviously, we
Yes.
want people to call you because you're going to be able
Share.
to advise them.
Yes, I believe in sharing is caring. Go
Awesome.
ahead,
Yeah.
send it out there,
Yes.
yeah,
Yes. So
and
I'll have
happy to
that
help.
available.
Mhm,
Great.
and the other thing too is we here at Equity Advantage, our whole office, we've been in business for 32 years, and we believe in, we call it give them the pickle. So Farrell's, if you remember Farrell's restaurant and ice cream.
Mm.
So Farrell had a deal about give them the pickle, and it just meant give them more than they asked for. And so all of us here, we are happy to consult if you've got questions. It doesn't matter how big or small that conversation ends up being, if it's 30 seconds
Yes.
or 2 hours, we are here to help get you on the right track. We don't charge for that. We're
Amazing.
just happy to help. So throw that out there
Fantastic.
too. Yeah.
Love it. Well, thank you so much for a succinct but also in depth. I feel like there's a ton of information in there. So, again, folks, I'm going to put this back up here on the screen if it'll let me. Here we go. Here's Tina's contact information and where you can find her. Give her a call, send her an email with your questions about the 1031 exchange process. And we'll end this today with just a super quick round. And it's really only going to probably be one question, a major question. I was telling Tina before that real estate, would you rather? And last week's question was pet urine damage and smell versus cigarette smoke damage in a property. So this week's question for you, Tina, is imagine that there are only 2 properties left available for you to buy. You have to pick one because that's how this game works.
I think I've
Would you
been there
rather?
already.
In this market we've had the past few years, a lot of people have probably been in this situation. Would you
Yeah.
rather live next to a gas station
Oh,
Or would you rather live next to a fast food joint?
hmm. I think I would take the fast food joint, especially if it's a Burgerville.
Perfect. See? Okay. Perfect.
I'll take it. Um,
Yes.
but it also depends. I think my decision would waver if the house is located where the folks are driving through, and so I would have, like, the headlights from the cars driving through in my front
Right.
window every day. I think
Yes.
then I may have to switch my answer. It's all about location,
Yes.
location,
It
location.
it is.
That
And
could
it's
be a key factor.
if Oregon had, like, Buc-ee's gas stations, which we don't have up here, where it's, like, fancy, whatever,
Yeah.
I might say gas station, but that's not how we don't have that here. I think I might have to agree with you. I think I'd rather have the fast food joint by my house, right next door or behind or whatever, adjacent to my property. I think that neither are ideal, for a lot of people. It's all subjective. If I'm talking about myself, I don't know. I think I might pick the fast food joint.
Yeah, and the other thing to
Yeah.
think about too, Jen, is, with the fast food, you're gonna get that fry smell. It may make you hungry all the time,
Yeah.
but I would say it's better
Yeah.
than, gas station filling up with their petrol.
Agree. Agree. Well, and on that note, we'll end this today. So thank you all for hanging in there with us and watching. Thank you to Tina for being here today. Appreciate you. And I'm Jennifer Schurter. I'm with Real Broker. And if you're looking to make a move around the Portland suburbs and you want to know what it's like to live out here in those cities that aren't in Portland, I'm here to help. Give me a call. And thanks for watching. We'll see you next Thursday.